Hello and good day to everyone who's joining us for Software Group's first ever Digital Finance Deep Dive. This webinar series will hear from digital finance experts across the globe who will share their industry insights and highlight their experience with success stories in digital finance, digital transformation, and financial inclusion made possible through digital innovation. My name is Charlene Bachman. I'm the Director of Customer Success at Software Group. Software Group is a global technology company specialized in digitalization and integration solutions for organizations that provide financial services. We help financial service providers successfully go through the process of digital transformation, extend their outreach, and improve operational efficiency. Software Group is committed to financial inclusion, innovating for a global economy that includes everyone. We also value the knowledge and insights that we gather from our own experience in the field and in our interactions with industry leaders. We hope this initiative can serve as a platform for knowledge exchange within the Software Group community. On that note, it is with great pleasure that I welcome Mr. Kaiser Naseem to our digital stage today. Kaiser is a global thought leader, disruptor, and innovator with an entrepreneurial flair. A banking and digital transformation expert, Kaiser is currently working with several banks and financial institutions globally to assist them with strategizing their digital journey. Leveraging his broad experience on a global stage, he has served on the board of several international companies and provided strategic advice to senior management and business owners. Kaiser was designated as one of the top 50 fintech influencers in the Middle East in 2017 and top 100 global fintech influencers for sustainable development goals in 2019. Kaiser serves as an advisor to the MENA Fintech Association and a member of the Arab Monetary Fund's working group on fintechs in the Arab world. Thank you for joining us today, Kaiser.
Thank you, Charlene. It's a pleasure being on board and given this opportunity. So I'm grateful to the software group as well. Thank you for the opportunity.
It's absolutely our pleasure. Before we begin, I wanted to make sure that the audience knows how to submit their questions. So here's a brief slide just to explain how to go from the GoToWebinar menu, select the questions box, and type your questions into the text box. We would love for you to submit your questions as they arise throughout the interview, and then we'll reserve the last 20 to 30 minutes for questions from the audience. Okay, Kaiser, are you ready to share your insights with us today?
I'm ready to go, Charlene.
Great. So our first question is really just to get to know you a little bit better and understand how you found yourself in the digital finance space.
Let me just add a welcome to the participants, whoever is attending. I believe there were more than 100 who had signed up. So welcome to everyone. And to your question, Charlene, I think in 2019, almost everyone finds themselves associated with digital finance in one way or the other. I think it's just the differences in why they are associated with digital finance. And the reason why I am associated is because given my background, as most of you would know, in development finance, our primary objective has been through the years, even before digital finance, is to help emerging economies develop the private sector for financial inclusion, for increasing outreach to small businesses. So that's been our objective for the past, in my case, 25 years plus. 5 or 6 years ago, obviously, this task of ours, or this objective of ours, was facilitated by the advent of technology, because the technology enabled faster outreach, better processing time for financial institutions. So our interest as an institution and mine as a professional was greatly focused on how we could use this technology to be able to do what we were already doing, but doing it more efficiently. So that's how I found myself in this space, I would say about 5 or 6 years ago. And I think most of us who are in this space probably wouldn't have a longer history than that. As a matter of fact, it's been gaining momentum each year over the past 5 or 6 years. And I can tell you, just before I end, that it's fascinated me, and I think it's fascinated a lot of others. And we also have now, I probably later on in my talk, I'll mention that facts and figures of how this technology over the past 4 or 5 years has enabled faster financial inclusion. So I'll just stop here.
Sure. And I think that's a great segue into our next question is, as we're seeing this increase in adoption and increase in innovation, where do you see the hotspots really of innovation in the market today?
Okay, so there are two ways to look at this. I mean, hotspots in terms of geography and countries, and hotspots in terms of the type of technologies.
Right.
Well, firstly, geographies, obviously, I mean, it all emanated from Silicon Valley. That's where technology and innovation started from. But today, in 2019, I think all geographies have some form of innovation going on. Not only innovation going on, but a lot of jurisdictions have established hubs for promoting innovation. So we can look at Europe, which obviously London has now become the center of fintechs. We can look at Asia, Singapore, China, obviously, good geographies to look at. I think the fastest growing digital finance services or fintechs are in China. And that's not only because of the population there, but actually because of how they are facilitating innovation. And of course, Hong Kong and Singapore. If you go to the Middle East and North Africa, you look at the GCC. And within GCC, you see UAE having positioned itself to be the hub not only for GCC, but for the MENA region. So in geographies, I would say all geographies are becoming hotspots. They are differences in the type of regulatory frameworks, and we can talk a little about that. I don't think we have enough time to delve into it, but again, later in the talk. In terms of technologies, it all started, obviously, as we all know, and even to date, the most the most use of technology is in payments. And the reason for that is very simple. First of all, there was a big market for that, especially in terms of remittances. And this was a big pain point for not only overseas workers, but even for professionals who wanted to remit money. I mean, even myself, for example, if I wanted to send money to my kids who were studying in another country, it would take days and ages. So that was a big pain point. So that was addressed. Today, we see a lot of innovation and technology being focused on processing of credit, both back office and front end. And the reason for that is for small businesses and for financial inclusion. That was a pain point. And today and going forward, again, we'll talk a little more about this later on. It's KYC and how do you onboard the financially excluded. So technology would enable that to happen a bit better than it's happening right now because of the availability of data and making better sense of the credibility of those who we want to be banked. So I would say these are the hotspots. There are a few others. Again, as we go along, we'll mention those. I'm sure there'll be a lot of questions on AI. So that's a hotspot. Blockchain is a hotspot. I think there's a question down there on that as well. So I'll just stop here on this question.
Sure. And, the geo hotspots that you're mentioning, being the fintech hubs and payments leading that space, I mean, it makes us kind of wonder which players are going to have the advantage. If those are the hotspots in the market, then who's really leading those and who has the advantage and why do they have the advantage in the competitive environment that they're working in?
Okay, that's a very good question, actually. And the players have evolved. I mean, we know FinTech 1 and FinTech 2, and I think we're getting into FinTech 3 now. So initially, when this financial technology or this innovation happened, so a lot of us were just sort of skeptic about it, that, these are passing fads and, the banks will remain as they are and no one is really going to adapt technology. And then we went into a phase where fintechs claimed to be eating into the bank's territory and that they would claim, the businesses that banks typically did. And then we went into FinTech 2, where they started partnering. Now what we're seeing, I mean, there are three things before I go on. There are three things which an innovation needs to have for it to have an advantage. The first one is, and I think that we've spoken about it, is that they're addressing an issue or they're addressing a pain point. So like the payments, so that was a pain point, and hence we saw growth in that sector. Credit assessment, risk assessment, KYC is a pain point. So we're seeing growth in that sector. So there has to be an issue that needs to be addressed. The second part is that there should be resources available to have whoever is innovating. So in terms of funding and in terms of human resources. So there we've seen restrictions. So a lot of innovations have been restricted mainly because of actually HR than funding, but also because of funding. So you need to have address the pain point and you need to have the funding. And the third is the ability to reach out. So the outreach. And outreach, as we know now in 2019, is because of the data that you have on your clients that you have dealt with in the previous life. So if you have that in whatever form, and most banks had it in whatever form, and now they're trying to organize it. So outreach would depend on that. And that is why we saw fintech too, because the fintechs themselves did not have the outreach, and hence they had to partner with banks. So these are three essential elements. So coming to 2019, and actually even the last year, we see a lot of these tech giants who have a lot of data and clients already on their books, the Amazons, the Apples, the Walmarts of this world, who are now entering this space of financial services. So payments, even credit now, and even remittances in most cases. So I think these players going forward would have a lot of advantage in terms of addressing the financial needs of clients. And not only because of what I mentioned, but also because of the fact that a lot of them are also offering services. For example, Walmart, or for that matter, Apple, where we can purchase online, but then we have to connect with the bank to make the payment. So if Walmart starts offering the credit and the payment platforms themselves, obviously they have an advantage, and they've started doing that. Actually, I think even in the past week, there's been some development on the Walmart front in terms of having an advantage in this area as well. Again, I stop here. It's a broad subject. We can keep talking about it, but let me just end it here.
But I think you're bringing up a really, sorry, the slides got switched. I think you're bringing up a really good point in terms of, the identifying the pain points, and that's really where organizations are getting an advantage by addressing those pain points. And we actually are seeing a number of players who have identified that there is a large number of underbanked population that still exists in the world today, and so there's more players coming into the development finance space or serving financial services to the base of the pyramid, or the unbanked or underbanked segments and SME segments. So what technologies that do you think have had the greatest impact on financial inclusion, let's say, in the last 5 to 6 years that you've been working in the space?
Okay, again, a good question. And I think the technologies which have had an impact thus far, and we have the figures, are the payments. So the first technology that was the first innovation that we saw. And the reason for that is because of the ability. I mean, we know that in developing economies, emerging markets, there's a lot of overseas workers working in different countries, and they are remitting money to their own countries every month, and that remittance is the source of sustenance and financial inclusion of the population of those countries. So Pakistan, Philippines, India, Africa, we've seen that happening. And because of the fact that it can now happen faster, almost simultaneously, we see a lot of financial inclusion happening. So payments have made a big difference. The ability to onboard unbanked clients has had a big impact. So KYC, it's not perfected yet, but in many countries it's been introduced. And the reason for that, actually, which is I would talk about that in when we talk about regulatory, but I can mention it here, is there's been a tiering by some central banks of the KYC requirements. Because if the KYC requirements remain as they are, even for an individual who probably has $100 bank account and uses it twice or thrice a month, the level of KYC needs to be different. And a lot of jurisdictions have done that. So onboarding a client, which probably poses less risk through a KYC app or fintech, is easier now. And that has helped financial inclusion also. So that type of technology. The third technology is the ability to process credits faster. So again, we all know that small businesses and SMEs used to suffer, and still suffering in many cases, because of untimely availability of credit. They may have got the credit, so financial access may have been there, but they did not get the credit on time. And we know that for small businesses, on-time credit is essential. So that's happening now because of the ability to process the credit faster. So I would say in top three, these would be the top three technologies that have enabled better financial inclusion and outreach.
And we actually see, the challenge of onboarding ourselves and a number of technologies coming into that space. And do you see also the different models that have been most effective when we're talking about the technologies for onboarding? There's the digital financial applications, or agents onboarding, or self-service onboarding. Have you seen any be, I guess, most effective in the financial inclusion space? Just to dive a little deeper.
Sure. I think you mentioned agents, use of agents networks, and a lot of jurisdictions allow that. Actually, a lot of jurisdictions don't allow that also. Turkey is one of those. They don't have a regulation on agent banking. But let's say India, Pakistan, a lot of countries in Africa. I mean, we know Kenya, all of us know M-Pesa. So agents have helped a lot in financial inclusion through enabling the agents themselves to use digital technology by providing them with the technology, with the smartphones, and also enabling them to train the users or the clients of that agent. So that's
Absolutely.
also happening. So there's a lot of training of the agents as well. So that's helped a lot. So that's very important, by the way. So appointing agents and how you do that is an important part of using the agency network. And there's a lot of work has been done on that by our institution, by CGAP, by many other institutions as well. The other is digital identity. So e-signatures, for example, this is evolving. I think recently, if we look at a few countries in Eastern Europe, I think Serbia, Ukraine, I'm not sure if they passed the law, but there's a legislation now being looked at. I think in Serbia and Ukraine, they've actually passed it, which allows e-signatures. So a credit officer can get a signature offsite. The client does not have to visit the bank. So this was a pain point. So things like that. A lot of jurisdictions still don't allow that. In Serbia, again, you can take a photograph. The agent just certifies that I saw the person in front of me, and the KYC is done for a certain level of client. So these type of regulations will facilitate, easier onboarding. And we are seeing this happening in Eastern Europe. We're seeing it happening in Asia, in China already.
And you're also bringing up a really interesting point of what's being allowed and the different laws that are being passed. So what regulatory changes or new policies have you seen to really be enabling DFS in the markets where you've worked?
Okay, so these that I mentioned, the e-signature is a significant one. But before that, let me just sort of put it in context. Many of you may have heard me speak earlier. I've always been of the opinion that regulations always follow innovation. So, and we've seen that happen actually in real life, that the regulations are not there, but innovations are there. And in some jurisdictions, they've been used also for payments, even for credit. The US, the crowdfunding, and in many other countries had started before there were any regulations actually even. So regulations follow. Now I paraphrase that with actually, because of what's happening in the last year, is that they do follow, but there's a lot of responsibility on the innovators to ensure that the regulations that follow are conducive to their innovation. And we see a lot of faltering in that. I can elaborate maybe in later questions on what I mean by that. But there's a responsibility on the innovators themselves to make sure that the regulations which will follow their innovation are conducive. And the only way they will be conducive if that innovation has been used responsibly. And again, we've seen a lot of it being used not very responsibly. So that hinders that. But the type of regulation that are required, one is these tiering of KYC, because KYC is a big issue, by the way. It's a big issue because it's not a country specific issue, it's a global issue. Especially when you're talking about remittances and you're talking about opening of letters of credit and cross-border trade. So KYC is a global issue, and tiering is a local issue. So a local central bank can tier it, but it has to be tiered in a way which is recognized globally. But tiering has happened in countries like Pakistan. If I recall, maybe I have the countries wrong, but in some countries in Eastern Europe and Africa also. So that's a good regulation to have um, for KYC. Digital identity, allowing digital footprints, allowing distance KYC, so not having to physically be present in the bank and signing in front of a credit officer. So these type of regulations we see are evolving. So these are happening. Yeah, I think these are the type of regulations we want to see. There's a lot of regulations on artificial intelligence, but if I understand, you have a question on that later on, so maybe that's where I'll talk about that and the regulatory framework around that and how that will evolve, in my opinion. So we can speak about that when we're in that
we will
section.
get to that for sure. I guess just on this topic, what advice would you give to organizations who, have done their homework, identify a need, let's say, for agency banking? There's a large rural population who is currently unbanked, and they see the best and most efficient way to serve them would be through setting up an agent network. But maybe the regulation doesn't yet exist. So how would you advise them to, solicit the regulator? Kind of, what would the process that you would advise them on that?
Okay, again, a very good question. And this is something we do a lot of because, like I said, regulations are never in place. They're always following innovation. And a lot of that, how those regulations are framed, would depend on the innovators or the users of that innovation themselves. And therefore, they need to articulate why that innovation has taken place and how it is going to address a certain pain point. And those pain points are actually issues which are recognized by the regulators also. They know that these are pain points. So it's how they articulate it. So the best way, or one of the ways to do it, is through a platform for articulating that. And those platforms could be associations of fintechs, they could be the association of banks, but there should be a regular dialogue between the regulators and the users or the innovators, users of technology or the innovators themselves, on why they think this is a good technology. Uh, and in some jurisdictions, we've seen regulators adapt a different method. That is, they're trying that innovation without harming the broader market. So the sandboxes, we all know what sandboxes are. So Singapore, I think, was one of the first ones to have set up a sandbox. We see a lot of jurisdictions now doing that. Even Tajikistan now has a sandbox environment where these technologies can be tested. And a lot of places like UK was the first one, by the way, which had the sandbox. So a lot of those technologies were tested in the sandbox before being sent out into the market. So this is how regulations evolve. You cooperate with the regulator to ensure that those regulations are in line with what the technology is offering. This is something which happened last year, I think in March 2018 in Mexico, which, by the way, has one of the best fintechs. It was the best at that time. So maybe others have copied it, or they've come up with better solutions. And the reason they felt for that, they wanted to regulate fintechs, was because they saw that the fintechs were addressing pain points, but they were not addressing the requirements of consumers. or protecting consumers. So most of the regulations are now around how these platforms, first of all, what areas they can work in. So I think in Mexico, it's like crowdfunding, it's credit, it's payment systems, about 7 or 8 areas, and how they should ensure protection of the consumers. So these type of regulations have evolved even in Mexico, which was the leader in fintechs, by the way. I think Brazil was number one. Mexico has always been number two in Latin America in terms of the number of fintechs and what they were doing. So I think that's how regulators and innovators and users of innovation should be interacting, working together to ensure conducive regulatory frameworks.
And I'm sure you have many, many examples. As I've also seen many organizations who have worked collaboratively with regulators, and then were able to, introduce something that was then a model, right, for other leaders in the industry or in the sector to be following. So we could spend more time about that, but as you mentioned before, we do need to touch on the AI subject because that is a hot topic for everyone in the space at the moment. So where have you seen artificial intelligence successfully used in offering digital financial services? And then I guess an additional question to that is, how has it changed the landscape where that was introduced?
Yeah, I mean, look, AI is being used across all these technologies. I mean, because all these technologies are using data. So that's the raw material, if we may, of
Right.
artificial intelligence. I mean, that's what is being processed, not by humans anymore, but by algorithms designed by humans and programmed by humans, but is being done. So in all these areas, artificial intelligence has been used in making payments, in identifying clients for KYC purposes, and in processing credit. I think I don't know if that's the correct thing to say, but I think in terms of credit, because I come from SME background, right? For me, access to finance and the right timing of that access is essential. So because of the ability to use the data and come up with a decision faster because of AI, I think that's been one of the better uses of artificial intelligence in the last couple of years, of how credit assessments are done by a lot of institutions. Now, let me now then dwell on the issues that have arisen out of that. And I think most of us are familiar. And again, this brings me back to my point on the innovators themselves having the responsibility to ensure that the regulations that follow are conducive for a sustainable use of that innovation. Unfortunately, we've hit many roadblocks when we talk about artificial intelligence. And most of those roadblocks are because of the improper use of data. So it's data privacy. So whose data can be accessed to then use to have artificial intelligence process that, how that can be accessed, and then the type of use that is being made of the results of that. Again, we all remember the election in the US and the controversy generated, and, Cambridge Analytics and Facebook and all that. It's still ongoing. I mean, that controversy is ongoing. So, in my opinion, because of those issues, anything else that Facebook innovates, for example, the new cryptocurrency that they're trying to innovate for financial inclusion, which is a very noble cause, and they have very good partners on the Libra currency, is facing a lot of issues. And that is because of the track record that they have had of using data for whatever purposes they use it for. So that's what I mean by when I say that they have to use it responsibly. So we'll see, I think, going forward, a lot of regulatory a lot of regulations around the use of data, around privacy of data, around how it can be accessed, how it can be used. So that's going to come. And it may not be very enabling for the use of that data because of what's happened. So far, it's been used properly in, like I said, in credit, in payments, in eKYC, and everything. But going forward, maybe that will slow down. The pace might slow down because of the way a lot of innovators have behaved in the past couple of years because of those reasons. Uh, yeah, so that's. I think that's going to happen.
So
There's
perhaps
something
more
else that came
adoption
to
of the
mind.
standard use cases.
Yeah, so either standards or regulation. I mean, there should be some standards for sure, and there are a lot of institutions that are working on it. I mean, there are a lot of these. I mean, Oxford. Let me see what it's called. They already have a study on it. Amazon is involved in a study. All these big five players are involved in some sort of study on how better to have standards on the use of artificial intelligence. I think it's called the Center for Governance of Artificial Intelligence at Oxford. So they think that the use of robotics and AI has to be carefully managed, and therefore there should be some sort of standards on it. We see the likes of Amazon and Apple and Google, Facebook, IBM, Microsoft, they've all grouped together to frame best practice for AI. I don't know if they're the best institutions to do that, but they're doing it. I mean, at least in form, if not in spirit. So these things are going to happen, and this would actually slow down the pace. Yeah, what came to my mind was that there are even biases now being noted in the use of artificial intelligence in HR, for example, in hiring. I'm sure you must have heard of it. So the biases have crept into the algorithms because of the biases of those who wrote those algorithms in hiring. So there are reports of discrimination between male and female in the hiring process, even by artificial intelligence. So that's become a big issue. So these are type of hurdles which slow down the pace of developing artificial intelligence or using artificial intelligence.
So
Again, I'll
there's still
stop
room
there.
definitely still room for improvement there.
Absolutely.
Yeah. Well, allow us to get to the next. We have the two main topics that are always a must discuss in digital finances. The next would be, of course, blockchain, and just to narrow down the topic a little bit, let's talk about some specific examples where you see blockchain playing a role in financial inclusion.
Okay, so blockchain seems to be the flavor of the decade. And I'll admit right now, I'm not very familiar with the technology of blockchain. I mean, I know what it is, of course, distributed ledger and the ability to record whatever needs to be recorded, not by a centralized body, but sharing it and thus improving the reliability. So there are a lot of uses for it. I mean, logistics is the first one that comes to mind. So not financial inclusion, but I think Maersk lines, the shipping lines, were the first ones to use it to cut down the number of documentation required when shipping, goods from one place to the other. So that's been proven. The other is trade finance itself. So I'm not sure if there are actually many use cases. I mean, I know we all may have read about certain banks. The most recent I read was in the UAE. I think it was either HSBC or one of these banks with a local bank in Singapore, and they said we now have trade finance on blockchain. So my understanding was that there was one transaction that they piloted. So one transaction had happened. So I wouldn't call that a successful use right now. But the technology itself for sure can be used for trade finance. And when we talk about trade finance, we're talking about financial inclusion as well, because trading between nations helps more and more small businesses to get involved with the value chain. So, in a way that's financial inclusion. It is happening, but I would not venture to say, okay, this is where it has been successful in financial inclusion yet. But it will definitely, I think over the next year or two, we will see that happening for blockchain as well.
So it's a space.
Is that a good answer?
Yeah, it's a space we need to keep on watching.
Absolutely. I think all of us should be watching that space for sure.
As good an answer as any. Okay, so our final question before we open it up to the audience.
Shadin, if you allow me, can I just go back to the
Please.
AI successfully used? One successful, actually, I would say, because I've seen it happen in a number of cases, in an agriculture finance. in China and in the Central Asian republics, actually in Uzbekistan and Kyrgyzstan, uh, the use of artificial intelligence to predict crop growth based on historical data has helped banks to lend to farmers in all these countries that I mentioned, and it's already happening. Big banks are able.
Calculate their risk.
Yeah, they are able to identify not just the risk, they are able to identify what the cash flow of the farmer harvesting a certain crop would be over the next 6 months. So let's say it's $100. So then a $50 credit by that bank is a no-brainer. And that's happening. And farmers were the most excluded because banks had no ability to identify or be able to assess the risk of growing a certain crop. They couldn't do that. They weren't farmers. But because of AI, based on historical data of that crop in a particular area, the banks have now got a tool. And again, the institution I work for has enabled a lot of that to happen, but so have many others, whereby this tool can be used to predict that if you're harvesting cotton on an acre in Kyrgyzstan or West Kyrgyzstan, this is what your expected harvest is going to be. And the price has been so and so for the last 3 years or whatever. And therefore, the cash flow will be so many dollars, and we can lend you this much amount. So that's a good example, actually. I just wanted to make sure I said that.
Yeah, that's a great example. And I think, I mean, to be able to replicate that, across many different markets, and for the organization who developed this tool to be able to scale, I think will be absolutely key, because being able to support agricultural finance across all of the regions who are active, have active agricultural sector, would really help to boost the economic development in those markets.
That's absolutely right, Charlie. Absolutely, it needs to be scaled and taken to other jurisdictions.
So because we want to give enough time for the audience, I'm going to get to our last question, which I think we've created a lot of suspense over. What your 3 predictions for digital financial services within the next 10 years? What would those be? And then we're going to follow up in 10 years and confirm whether or not you had it right.
Okay, so I knew there'd be a question like that. There always is. And look, I mean, these are predictions at the end of the day. And what I'm predicting today, perhaps I predicted differently, maybe as recent as 6 months ago. So it's a moving target. And again, a moving target is because of the way we are, again, I don't know if it's the right word to use, but behaving not we, but a lot of us are behaving in the use of technology or the use of innovation. So these predictions either slow down or they change. What I think, I mean, just to generalize, the top 3 for me would be, I see a lot of legacy financial institutions now adapting digitalization. They will adapt. Those who were skeptical maybe even 6 months ago have realized that they need to adapt digitalization. They need to leverage technology. So that's going to happen more and more. And when I say legacy institutions, I'm talking about emerging markets. So a lot of these institutions in emerged markets or developed economies may have realized long ago that they need to. Not necessarily they know how to, even in developed economies. A lot of them don't know how to, but they know that they need to. So in emerging markets, we'll see more and more that happening, and therefore there'll be a lot more demand for innovations, particular to a country or a landscape. So that's number one. And within number one, I would see we'll see a lot of partnerships happening between fintechs and banks in these emerging markets, simply because of the fact that most of these banks do not have the resources of innovating themselves, and they shouldn't be innovating themselves either, even in developed economies. So they'll be partnering of fintechs. So that's one thing I predict this will happen in the next year, not 10 years. I think we will see for sure, and this is where I'll bring in that figure on financial inclusion. We will see for sure more financially excluded being included into the formal financial sector because of the use of technology. And this has already happened, because if anyone is following the Findex report that is published by the World Bank every 4 years, so in 2014, the excluded were about 2 billion of the population of the world were excluded from finance, access to finance. In 2018, it's 1.5 billion. So last year, every 4 years it's published, it's 1.5 billion. So 500 million were excluded in 4 years. The 4 years prior to 2018, it was about 300 million which were excluded, or 250. So we would like to believe, at least I would like to believe, that the pace that increased of financial inclusion was because of the adoption of technology. And this would be proven, or should be proven. So that's the prediction, that in 2022, when we have the next Findex report, so this figure from 1.5 should be about 0.8 would be excluded, if not less than that. So even more than 500 million more would be included into the formal financial sector. So that's my second prediction. The third one is that, having said whatever I did about artificial intelligence, we'll see more and more use of it, because it would have been regulated. And without the use of AI, and without the data being organized so that it can be sliced, diced, and interpreted, there is no use for innovation. There is no pain point that would be addressed. So we'll see more use of artificial intelligence, but accompanied by regulations, especially on security, uh, and obviously the use of data and privacy. So this is going to happen. We're going to see more, and this is going to come sooner than the next year or so. The regulatory framework on how artificial intelligence, robotics, data can be used. Is that okay?
So, yeah, if your predictions are correct, I think the two of us will keep quite busy over the next 10 years.
Absolutely.
And maybe we can get closer to the goal of full financial inclusion as we continue to assess the progress. That's all the questions that I have for you, though we could certainly spend days unpacking some of these complex topics. But let's go to the audience questions and see what we've inspired from our conversation. The first question is, you mentioned blockchain. Now, how applicable do you think blockchain technology would be for financial sector from a transaction point of view? How do you think this is applicable for, I guess, payments and transactions in the financial inclusion sector?
Well, yeah, I mean, look, like I said, I'm not so familiar on the technology front, but on the use of this, and I mentioned a few already, absolutely. I mean, anything which needs to be recorded, and not by a central, but recorded in a manner that it is trusted by a wide number of people, of bodies, blockchain is the technology for that. So payments, remittances, trade finance, I see the use of blockchain happening in these areas for sure.
Okay. And then how do you see open banking and PSD2 regulation in EU changing the financial services?
Well, we've seen an impact already, of course. I mean, there's been, you being in Europe, you probably know that better than anyone else. There's been a lot of confusion. I think at one point, I don't know the latest figures, but maybe 8 months ago, 75% of the institutions were non-compliant, although the deadline had passed. And I think then they extended it, if I'm not mistaken. But definitely, it has been welcomed by consumers, by the owners of the data, because this option to be able to own your data and then to access, whoever you want to access in terms of your banking needs, your financing needs, is something positive. And I think open banking is here to stay, and simply because that is what a consumer would want. They do not want to be restricted to one financial institution. The only thing I see, maybe a hurdle, again, going outside of Europe, is on the technology front. That in order to be or to adapt open banking, you need to have the ability to open your platform, for example, for different types of apps to use the platform of the bank. So that again would depend on particular regulatory frameworks in each country, how open that can be, and also on the ability to change the legacy platforms that exist in those banks. And I'm talking about banks in Iraq and in Yemen, Pakistan. But Pakistan probably is more sophisticated. Lebanon is more sophisticated. Egypt is, but even there, they are legacy systems, which, because of technology, the commitment may be there, but would not allow unless you've plowed in a lot of money. Having said that, now they are also, in terms of fintechs, technology platforms available where legacy platforms can just be fixed. I mean, this new platform can just be fixed on top of the legacy platform. So you don't really need to change the whatever legacy platform a bank has. So yeah, I mean, open banking will happen because the consumer wants it. And I think at the end of the day, market is what demands where things move. It's the demand from the market. The market would determine what's going to happen, and open banking is going to happen.
So but as you said, in the emerging market, there would need to be much more of an adoption of some more flexible platforms that support integration, or more partnership that we're seeing between fintechs or tech firms that can provide these. And do you see it being individual investments that the institution would make, or do you see it being something that would be on a more national scale? I mean, you hear about these national national platforms that could be available, like the Level 1 or the Moja Loop system that Gates has developed.
Yeah, absolutely. I mean, two or three things. One is just coming to the regulatory part of it. Central banks in almost all jurisdictions are very proactive. They're actually wanting technology to play a part in financial services everywhere. I mean, I don't think there's any central bank which is saying we don't want it. The only reason they probably are lagging is because of the resources that are available even to central banks. And this is scarce. I mean, even the best of banks don't have the right resources. So that's what's keeping it back. In terms of who will do it, it's both ways. I mean, individual banks would want to invest in ensuring that their technology platforms are enabled to use properly leverage the technology. And in terms of at the national level, we have these payment platforms. We have the likes of Aadhaar in India and Nadra in Pakistan, where KYC or credit worthiness is centralized. You can access data. So, and even Serbia, for that matter, it's it's a centralized database for KYC or credibility assessment. So we'll see both things happening. But in terms of processing, obviously, it has to be individual banks doing that themselves. So a lot of partnering. You're absolutely right. But again, when we talk about partnering, this again is a subject on its own. The how to is difficult. How do you partner? So what type of partnership is needed? Do you go out and buy a fintech? Do you have a revenue sharing model with the fintech? Do you do it per transaction? So it all depends on the market, the size of the institution, what fintech it is, what the regulations are. So that partnership would depend on this. So, but banks, I've seen, I mean, at least in my experience, have difficulty in trying to formulate that partnership. And I've actually spoken with, I think I mentioned that earlier in some other place, that I've spoken with fintechs in the UK, at the Lendit conference. And they were having difficulty in expanding into these emerging markets because fintechs also were not able to forge these partnerships with banks in emerging markets because they need to move out to emerging markets if they want to scale. But forming these partnerships is an issue. So that's something which needs to also be addressed.
Right. Okay. So how to inspire more partnership, or how to ease the partnership process to make sure that there's value created by both sides. I mean, I think that's again, things with different examples of successful use cases are always going to be helpful with that. So I think the more that we are able to experiment and try different models and then be able to share the experience, I think hopefully we'll be able to ease ease the adoption process.
Absolutely.
To move back into kind of the financial inclusion space, there's a couple of questions here that have come up in terms of one, digital transformation. What is the difference with automation, and does it drive financial inclusion in your opinion?
Look, by automation, what I am understanding is automating or digitizing the back office processes. Is that what it's meant?
I guess, what is the difference between digital transformation and automation?
Well, automation is a part of digital transformation. Let me see if I can explain that, or if maybe I've not understood it properly. So when you talk about digitalization, basically what is digitalization? It's using technology, leveraging technology. The technology exists, but how does a financial institution use that or leverage that technology to enhance the way it offers its products? It reaches out to its clients. It provides services to its clients. So that's what digitalization means. Now, the reason for digitalization would vary. And that's why I always stress that any institution that says, okay, we want to digitalize, because that's a very general, they also need to answer the question why they want to digitalize. And that question is only answered if they have a digital strategy, digitalization strategy in place. So for different institutions, the reasons would be different. I mean, I think everything has to be digitalized, but the priorities of what needs to be digitalized first would be different depending on what type of institution it is. Is it microfinance? Is it SME banking? Is it corporate bank or retail bank? So the priorities would be different. For retail, it's the customer experience, for example. So the apps, we've seen that. So that's not just digitalization. That's one aspect of it. You have an app because your customer is happy to see an app, but that's for a retail client. So so that so that's the first thing. The second is there are four reasons why you want to digitalize. So you want to digitalize to increase outreach. You want to digitalize to diminish or manage the risk involved. You want to digitalize because you want to reduce costs of your processes or your cost of distribution or cost of doing business, or you want to digitalize to expedite the credit process. So in these cases, once you have chosen, let's say credit process, I think for SME, small business, even micro, which is a single product, most of them lending, the credit process is very important. So there, the more important thing is automating, if you may, the back end process and not so much in the front end immediately. Well, obviously the KYC and stuff like that, but back end. So if that's what is meant by automation, absolutely. Uh, the process of assessing the risk of a credit and digitizing that or automating that will go a long way in ensuring that the clients are receiving their funding in the right at the right time when they need it, actually. So a lot of banks miss that and they concentrate on the front end. So back end automation of the processes. Similarly, the accounting process in a larger institution needs to be automated. The compliance and reporting, for example, for large banks, I mean, this is a major part of their expenses. I think, these expenses have gone up by 50% or even more for most of banks in the last 5 or 6 years, meeting compliance and regulatory requirements of central banks. So how do you automate that? Because these are monotonous, same type of reports, endless, taking up a lot of time of a group of individuals. A lot of banks have automated that. They have used digital technology. A very good example is Austria, for example, where banks have got together and centralized their processing of the compliance and regulatory requirement for the central bank. So there's one entity where all these five or maybe there are eight largest banks of Austria, and it's in other jurisdictions also, but Austria comes to mind because this was one of the first ones which did it. And they send their information to this processing center, which then sends it to the central bank. So it frees up time and thus reduces costs, operating costs for these banks. And if anyone is thinking about secrecy and privacy, so there are a lot of inbuilt mechanisms to ensure that the data is not shared between the eight banks by this entity. Again, I stop here. Big subject. We can talk endlessly.
Sure, but I mean, I think you hit answer the question, by explaining the turnaround time and the, easing the process, particularly for financial inclusion, to be able to reach more customers by having a digital transformation strategy, and in that case, automating some of your processes. You're able to then reach more customers and serve customers with a quicker turnaround time, and maybe even having some examples of the KPIs before digital transformation and after digital transformation, to be able to see the difference in operations and just difference in outreach. And so I think there's still some case studies out there, but I think there could be more done around being able to really show an organization who adopted a whole digital strategy, what their operations were before and after.
Absolutely. I think you framed it better than I did.
So I think we have time for one last question, and that is from with more and more people financially included, do you see a trend for consolidation among the financial service providers and entering of bigger players?
Well, consolidation is always happening in the financial sector. I mean, most of the countries I've worked in are overbanked. I mean, where I am right now, also in Moscow, if everyone is familiar. So there were, I think, thousands of banks, and they're closing probably 10 or 12 every day for the last 2 or 3 years. So all countries, there has to be a consolidation. If nothing else, for the simple reason of consolidating or reducing costs of servicing clients. So the cost to the client would be reduced by consolidations. So that will happen. Now, if these consolidations are going to happen because of technology, quite possible, because there will be institutions which would lag behind because of their inability to adapt technology faster than the others. So those who would have adapted that technology would have an advantage. And perhaps there would be consolidation in terms of mergers, acquisitions, and we're seeing that happening in at least a lot of countries that I work in. Even in the country I was based before I was in Moscow. And those, I think, a lot of our audience or listeners, participants would be from the UAE. So there's a lot of consolidation happening over there as well. So because of technology also. Now, we're also seeing a lot of non-financial institutions coming into the financial sector. So what's going to happen because of the Amazons and the Walmarts and the Facebooks coming in or into financial services? That has to be yet to be seen. I mean, frankly, I won't venture to say what will happen. I mean, what comes to mind is what Bill Gates said maybe now, a decade ago, that banking is necessary, but banks are not. So we'll still have banking and financial services. Who's going to do those tasks? Let's see. Keep our fingers crossed.
And there's still new players coming in, which is keeping things interesting, isn't it?
Absolutely. They're coming in and addressing what banks were addressing. Not only banks were addressing, but even the likes of multilateral institutions. So this financial inclusion has crept into the vocabulary of Libra, for example, and of many other institutions. So yeah, let's see. I mean, it's an open platform, and the reason that has crept in is technology again. I mean, technology has enabled all these players to say that they are working towards financial inclusion, which is right.
Certainly.
I mean, they're not wrong in saying that.
Certainly. Well, that's a very high note to end on. So that's all the time that we have for today. But thank you for everyone who joined us and for your challenging questions. And a special thanks to you, Kaiser, for taking the time to share your insights and predictions, of course, for our digital financial future. There will be another webinar in the beginning of October, so stay tuned for more details. And thank you again.
Well, thank you very much, Charlene and team. And again, thanks to Software Group for this opportunity. And thanks to all the attendees. Excellent questions. And thank you for your patience. Bye-bye.
Our pleasure. Take care.